Thank you for standing by and welcome to the Clever Culture Systems Quarterly Investor Call. All participants are in a listen-only mode. On today's call is Brent Barnes, CEO and Managing Director, and Ray Ridge, the company's Chief Financial Officer. I will facilitate a question and answer session at the end of the presentation. An audio recording of this call will be made available on the company's website later today. I would now like to hand the conference over to Ray Ridge.
Thank you, Jack. I would like to remind those listening to this call that today's update may contain forward-looking statements, which do involve inherent risks and uncertainties. Those risks and uncertainties include those disclosed in our ASX announcements, which we do recommend that you review. There are reasonable grounds for any forward-looking statements made today. However, due to their inherent uncertainties, we recommend that you do not place undue reliance on those statements. And of course, actual results may differ materially from those forward-looking statements. We're now ready to go, and I'll hand over the call to our CEO and Managing Director, Brent Barnes.
Great, thanks, Ray, and welcome everyone. We're pleased to provide an update on the progress achieved during the June quarter, which also marks the completion of financial year 26 or FY26. The objectives we set out for FY26 were very clear in that we needed to broaden and expand the number of global pharmaceutical customers using APAS. We described this in the context of our long-stated land and expand sales strategy, where we know every global customer will start with a single APAS instrument, and they move through a validation process, and then these global customers really have the most to gain by expanding the use of APAS as a standardized process for environmental monitoring across their global sterile drug manufacturing facilities. We said unit sales would be broadly at or around FY25 unit sales, which in that year was really underpinned by AstraZeneca. However, for FY26, the sales would be driven by an expanded number of global customers rather than being concentrated on a single customer. We described this being an important aspect to deliver in order for us to establish unit sales and revenue growth starting in FY27 and beyond. In the June quarter, we added 2 new global pharmaceutical customers, which meant that for the full year, we increased these customers from 4 to 8, doubling our footprint in this targeted segment. Unit sales for the full year were 11 instruments, consistent with FY25. But by this time, it was really spread meaningfully across a much broader customer base. We finished strongly in the June quarter. Specifically, we achieved 3 new APAS independence orders. We completed installations with 2 new global pharmaceutical customers. In June, CSL placed a 5-year lease order for an APAS independence instrument installed at their Broadmeadows facility in Melbourne. They will commence an initial evaluation of the technology with a clear outlook that if successful, there is a broader standardization potential across their global sterile drug manufacturing network. We also completed a placement of an instrument with another top 20 global pharma manufacturer who will commence a 6-month paid evaluation, again, assessing performance against agreed criteria for broader use across their global network. The final order in the quarter came from a smaller single-site drug manufacturer based in the United States, who became aware of the APAS technology and approached us. This reflects growing organic awareness and acceptance of APAS within the industry. Our global installed base now stands at 34 instruments, up from 30 last quarter, continuing to build our recurring revenue base. As stated last quarter, the focus in FY26 was about increasing the quality and the breadth of customers with APAS, and we now have 8 of the world's largest customers engaged with APAS at various stages of evaluation, validation, and expansion plans. In June, we hosted our inaugural APAS Discovery Day at AstraZeneca's Centre of Excellence facility in Macclesfield in the UK. The event brought together new and existing customers from 10 countries with presentations from AstraZeneca, Pfizer, Clever Culture Systems, along with hands-on demonstrations of the APAS independence instrument. That event was arranged to coincide with our first in-person APAS Expert User Group meeting. This group was initiated and formed by our existing global customers themselves to share insights and collaborate on integrating APAS within their businesses. There are currently 6 global customers as members, expected to meet 3 to 4 times per year, and over time we see this group as having the potential to act as a collective voice to industry and regulators on the benefits automation brings to pharmaceutical quality control processes. Turning to annual recurring revenue, our high margin, predominantly software license revenue now exceeds $1.3 million per annum, reflecting the growth of our installed base across both pharma and clinical customers. To summarise, FY26 reflects the successful delivery of a deliberate multi-year strategy, moving the company from a single customer concentration to a genuinely diversified customer base of some of the leading global pharmaceutical companies. We believe this is a key driver of sustainable long-term growth as we head into FY27. With that said, I'll now hand over to Ray to talk through the financials in more detail.
Thanks, Brent. I will now provide an overview of financial results we reported in our Appendix 4C lodged with the ASX in July. All figures are in Australian dollars and in accordance with ASX listing rules, they are not audited. Pleasingly, the company remains in a solid financial position with 1.7 million in cash at 30 June. Together with expected cash inflows of at least 3.4 million in the next 2 quarters. This comprises receivables, the estimated R&D tax incentive claim, and other known but committed inflows from customers. The majority of these cash inflows, up to 2.6 million, is expected to be received in the first quarter. In addition, the company has several advanced sales opportunities that are expected to progress to firm sales commitments over the next 2 quarters. Turning now to the reported cash flows for the quarter, the company had net cash outflows of 0.3 million, represented by 1.7 million in outflows from operating and investing activities, which included 0.6 million cash inflows from customers and 2.3 million cash outflows from expenditures, comprising our usual quarterly cost base of around 1.6 million, together with about 0.7 million that was related to sales costs and manufacturing, with some impact from timing from our GST refund and supplier payments. Net cash inflows from financing activities of 1.4 million was largely 1.5 million proceeds received under the short-term debt agreement, with a further 100,000 received on the 1st of July 2026, which is not reflected in our numbers. So that takes that total debt facility to 1.6 million. The short-term debt agreement was established to assist with the management of near-term working capital requirements, including managing the timing of customer receipts and inventory purchasing. The company considered the short-term debt to be a capital-efficient means of funding the business during this period of its land and expand sales strategy. The interest cost is based on an annual 10% interest rate, together with 16 million unlisted options. An amount of 1.68 million is due for repayment on the 31st of December 2026. That is inclusive of interest, and the debt is unsecured. So I think overall, the company remains well capitalised and maintains a disciplined management of cash flows and its capital structure. Looking briefly at the full year for FY26, which results are not yet published, the company completed the year with 11 instruments placed with customers. This was consistent with financial year 2025, although it really involved that broadening of our customer base or the land part of our land and expand strategy, with the number of large global pharma customers increased from 4 to 8. Breaking this down further, 6 of these sales resulted in full sales recognition, and of the remaining 5 placements, two resulted in recognition of what I'd say a part recognition of the instrument sale through a non-refundable deposit, and those are the instruments under evaluation. One was placed under a lease revenue model, and two were to clinical customers through Thermo Fisher using the last of their inventory. All of these 5 placements are expected to add to the company's prospects for financial year 2027, as evaluations are finalised, lease income is received, and any additional clinical sales now require an instrument purchase from CCS. Back to you, Brent.
Great. Look, thanks, Ray. Looking ahead, I want to make it really clear from the outset that we do expect FY27 to be a year of increased unit sales and increased revenue compared to prior financial years. Our multi-year sales strategy remains unchanged. However, what we have successfully delivered over the last 2 years gives us the confidence to set expectations of revenue growth starting in FY27 and beyond. Starting with that existing 8 global customers that we've already landed, this group alone represents a potential opportunity of up to 100 instrument sales, equivalent to approximately $50 million in upfront sales and $10 million of annual recurring revenue. Every large global customer will expand at a different pace, at a different scale, but it's important to point out that even if each of these customers orders 1, 2, 3 over time, it really illustrates the multiplier power of the expand phase of our strategy, particularly when we're talking across 8 customers and continually to grow from there. We do also expect to continue winning new customers during FY27. We currently have an estimated 80 instrument sales opportunities with new qualified customers at various stages of the sales process. The main friction point we see in converting these opportunities is the prioritization of internal customer resources required to embed automation like APAS into a highly regulated sterile drug manufacturing process. That's a customer side constraint, not a reflection of the interest in the technology. And this is exactly why establishing a wider base of qualified customers has been such a priority for us over the last 2 years. We have established initiatives to try and reduce the amount of time our customers need to test and then validate APAS. Successful completion of that testing and validation processes is a key step forward to accelerating customers into routine use and generating the expand opportunity with those new global customers. Drawing on our recent sales and market experience, we've developed a structured program to support customers through this process, providing more certainty of success. In June, we recruited a dedicated resource based in the UK to support this initiative with key customers, and we'll look to expand this service offering as sales grow. We also see the establishment of the APAS Expert User Group as an important initiative to influence our goal of APAS becoming the new gold standard in industry over time. Finally, in October and November, we'll be showcasing APAS Independence at 4 major conferences across Australia, Europe, the UK, and the US. These are some of the most significant events of our calendar each year, important for brand awareness, new sales leads, establishing Clever Culture Systems as a technology leader. We'll have a booth at each, and we've also been accepted to present oral presentations on the validation and use of artificial intelligence within pharmaceutical manufacturing environments. As we close out FY26, our sentiment is that we've delivered what we set out to achieve, a broader, more resilient global pharmaceutical customer base that positions the company for a step change increase in sales performance in FY27 and beyond. With all that being said, I'll now hand it over to Jack to facilitate any questions.
Thank you, Brent. We'll now commence the question and answer session. If you would like to ask a question, either use the Q&A function on the Zoom control panel at the bottom of your screen, or raise your hand and wait for your name to be announced. If you wish to cancel your request at any time, simply remove the raised hand. So first up, we have a question from an anonymous caller. Are we expecting any capital raise in the next 1.5 years? What is the timeline for being cash flow positive? And can we speak about the cybersecurity in general?
Right, yeah, loaded set of questions. Look, I don't think I can go any further other than what Ray and the company have outlined in our quarterly around the company being in a solid financial position. So Ray's already stated where our cash position is. We're able to facilitate a short-term debt facility to manage working capital, and I think pretty clearly outlined what our expectations were in terms of receivables over the next 2 quarters, notwithstanding the additions of new sales that we do expect, obviously, in the first half. So I think that's kind of on the financial side. From a cash flow positive perspective, I think the company, as it executes on a standard business as usual basis, we would expect to, obviously with the step change increase in sales, we would expect to be cash flow positive in FY27. And the last one, I think, was a general statement around cybersecurity. I don't really know what you mean by that. From a cybersecurity perspective, from the APAS technology, it's certainly a key consideration for all of our customers, and we go through a pretty standardized process, and we have done for on a number of occasions through all of the customer sales that we've gone through.
So another question from an anonymous attendee. After Thermo Fisher's microbiology business sale to Astorg, announced in April, is there any update on the new operator's intention with the current distribution agreement?
Great question. Short answer is no. No update on the outlook there. I think we certainly have had interactions with them, but I think in any case, just to kind of maybe baseline some understanding, the clinical part of our business is not a material part of our business anymore. In any case, we've progressed and putting really all of our focus into the pharma business. But look, it's not material to our growth projections, and B, the short answer is we haven't had any feedback from them at this stage.
And a question from Stella Wang. Congratulations on the growing clientele base. How are your competition progressing, such as Rapid? Rapid seem to have strong installed base in the cell and gene pharmaceutical manufacturing segment. Does CC5 focus on a slightly different sub-segment?
Yeah, so just to clarify, when I guess you're saying Rapid, it's Rapid Micro Biosystems, which is a US NASDAQ listed company. And yes, they make public announcements around their progress, and they have been quite successful focused in that cell and gene therapy market. The comment around do we operate in a slightly different segment is a really good one. Our focus is primarily in the high throughput biologics market. And so this is really different to the cell and gene therapy market, which is very much personalized medicine. The testing volumes or the drug development volumes are typically much smaller in that segment. And so really where our sweet spot is that high throughput biologic segment, which is a larger part of the overall drug manufacturing portfolio. And we definitely can coexist in this large total addressable market.
Thank you. And now we have a question from Peter Gregory. So Peter, if you unmute yourself and please ask your question.
Hi Brent, thanks for the presentation and quality of the information you've shared with us. Look, I understand the technical advantage that the product has, and I understand that it gives better reliability and consistency in terms of the reading of plates. I wonder if you could give me a bit of an understanding of what you think the sort of return on investment that customers get from getting on the APAC program.
Yeah, so typically the payback that we're seeing working with our customers is somewhere in the 2 to 3 year time horizon. Sometimes it's a bit sooner, sometimes it's a bit later than that. And the kind of with every customer sale, we do kind of a workflow. It's called a Gemba workflow in the pharma kind of context, and that means we go and have a look at their as-is process. We get information back from our customers, which kind of looks at the number of plates that are manually needing to be reviewed and kind of their internal workflows. And we work with the customer to do a return on investment calculation. So clearly that is volume dependent. The more plates that are manually being assessed, automation has a higher value, the more plates that is able to be automated. There's also a cost of quality So that's another important element that our customers look at. So, we have a very structured process that we work with our customers on a return on investment that we do as part of our sales process.
Thank you, Brent. So further question from Stella Wang. Are pipeline customers more likely to be on committed lease basis or still mostly upfront sale and recurring maintenance and license?
At the moment, our assumption is that it's principally going to be as the majority of our sales have been, which has been an upfront purchase. It was CSL, who's the only customer that we've had that has entered into this 5-year fully bundled kind of leasing arrangement. So I think it's too early for us to see that as an ongoing trend. I think the important message is that we have a procurement process that we can be flexible in offering either of those. But I wouldn't say it's signalling a shift or a change that we're looking to see more permanently.
The next question comes from Bryce Wetton. APAS Pharma User Group is working on a group validation process. Can you give us a bit more information on this?
Not really, sorry, Bryce, but great question. Look, it's still very much evolving, but the principles are, just to explain what that means, is that each of these customers have gone through their own internal validation process. They've all there's compendial guidelines, I should say, so there's a certain set of requirements that they must follow and demonstrate performance against. What the group are looking to do is to perhaps see if they can harmonise or to overlap and see where there could be opportunity for new customers to not have to do as much as perhaps what they have done as an early adopter. So I'd say it's early days, and when I say early days, we kind of formed this group, or our customers formed this group at the end of 2025. So we're kind of 7 months into it. It was great to meet in person in the UK recently, but there's a lot of inertia kind of getting behind this group, and I think probably what we would like to see at some point from this group is to have a publication that is co-authored by those groups of customers that we haven't announced specifically who they are, but they're obviously within our existing customer base.
And another question from an anonymous attendee. How far away are Pfizer from making a purchase order? It feels like their evaluation has taken a long time.
Yeah, look, all of our customers kind of go at their own pace and at different points of time, move quicker and slower. Look, Pfizer's been a great partner of ours, continues to be a really good partner of ours, and obviously their evaluation is being done in their Melbourne site, and it has been a couple of years since we started that, and I should say that's elapsed time, not 2 years worth of effort. And look, we'd expect that instrument to be kind of bought out from that site, and we are certainly, like all of our other customers, talking to these customer groups with a global outlook and looking at multiple global sites.
Thank you, Brent. There are no further questions at this time, and that does conclude today's call. Thank you for joining the Clever Culture Systems quarterly call.